Hi, and welcome back. In today's session, we're going to build on the material that we looked at last week when we talked about individual portfolios. Today we're going to take a look at institutional portfolios, and we're going to do that in two videos. In the first one, we'll take a look at pension funds. In the second one, we'll look at foundations and financial institutions. Portfolios tend to work the same way, whether we're talking about individual or institutional portfolios, but there's some fundamental differences. We always start off with the basic assumption that we have to know our client and understand the client's appetite for things like risk and requirements for return, liquidity, taxation issues, and so on. Today's session will look at some of the things that are specific to pension funds. Pension funds are an important part of our institutional investing framework in Canada because Canadian pension funds are very large. In fact, some of the world's largest institutional investors are those Canadian pension plans. Specifically today, we're going to take a look at things like defined benefit versus defined contribution plans and even hybrid plans. We'll take a look at the definitions of those and how the funding requirements and the risk requirements are going to be a little bit different for each. We'll take a look at the investment objectives and constraints for defined benefits as well as for defined contribution. And when we're looking at defined benefit, we'll particularly look at some of the issues that affect risk, like whether or not the fund is in surplus or whether it's underfunded, what's the sponsor, the fund sponsor, or the company behind the pension plan's own status and profitability, its ability to continue to contribute in the future. We'll take a look at risk exposures that are pre-existing for the sponsor and how those are going to affect the fund itself. We'll take a look at plan features and some of the things that are going to affect the workforce itself. Now, defined benefit is pretty much what it sounds like. The benefits that we receive from the pension plan will be known in advance. We put money into the fund through employment. Our employer contributes to the plan, and that money is set aside, and over a very long period of time, the fund will be drawn down by the people as they retire. Very common as a pension plan for people that work in government jobs, a lot less common for people who are working in the private sector, and it's becoming increasingly less common as more and more employers prefer to use a defined contribution plan. And I'll tell you more about that in just a minute. Essentially, defined benefit is defined by its benefit. It promises a certain benefit for a period into the future. Defined contribution doesn't give you a guarantee of what you're going to receive in the future, but it does actually specify what you have to contribute up front. So if you're contributing 6% and your employer's contributing 12%, that money's being invested. You could actually earn a lot more with defined contribution if your investments do well, but you could also be worse off. So the important thing for the sponsor, for the company that is helping to fund the pension plan, defined contribution plans don't create any future liability for the sponsor. Defined benefits may have to be topped up if they become underfunded. Defined contribution plans, participants bear the investment risk. In a defined benefit plan, it's going to be the sponsor. And defined benefit plans may also bear risk in the case of the plan being terminated. In a defined contribution plan, the investors, the contributors own their contribution, and so it's much easier to make it portable. And if the company fails, we don't have to worry about the loss of our sponsor. Defined contribution plans are, by their definition, portable. You can take them from one employer to another. We have a number of studies, the most recent of which that I found was one by Boston Consulting Group that tell us about the top pension plans in Canada. And you'll see from the center of this chart, some of the biggest pension plans that we have in Canada include the Canada Pension Plan Investment Trust. We have the BC IMC, the BC Investment Management Corporation, which manages, among other things, my pension. Things like the Ontario Municipal Employees Pension Plan, OMERS, the Ontario Teachers Plan itself, the Alberta Investment Corporation, and so on. Of course, in Quebec, the second biggest plan in Canada, the Caisse de dépôt de placement du Québec. So the again, another big government-sponsored pension plan. These funds, as of 2015, employed more than, or managed more than $1 trillion worth of assets. Their assets under management are growing quickly, partly because markets are growing, because funding is increased, but also because the number of people that are covered by the pension plan is continuing to grow, even though a larger proportion of those people in the plan are already retired. They generate about $600 billion in investment return. They manage the pension plans themselves. They do invest in stock markets and they invest in bonds, but they're increasingly interested in direct investment. They'll buy real estate. They will fund infrastructure projects in Canada and internationally. They're huge investors and increasingly more hands-on investors. In fact, Canadian pension plans are quite well known internationally because of their size. Of the top, in fact, going back to 2012, I believe, when this article was published in The Economist, it was widely recognized that some of the world's biggest investment managers are those Canadian pension plans. The pension plan, Canada Pension Plan Investment Board, for example, ranked 11. I believe that's actually risen to 4th or 5th in the world. The Ontario Teachers Pension Plan, the Ontario Municipal Employees Plan, and so on. So they're huge funds. They manage a lot of individual pensions, including things like school teachers and firemen, policemen, the military, all of those government employees. Those pension plans have a lot of economic clout. If they decide to invest in a business, that's an important signal for other companies, and so they employ a lot of analysts to make good decisions. Not all of their decisions are good. A great example from, I suppose about almost 10 years ago now, when Rona, which was based in Quebec and was a publicly traded company, was in discussions to sell its business, or even part of its business, to Lowe's. The Quebec government said that's not going to happen. We want to keep Rona as a business that operates out of Quebec. And so they actually had the Caisse de dépôt de placement de Québec, the pension plan, buy a substantial stake in Rona. So there's no interest in particular that was directed at the pensioners. They decided, well, this would be a good thing for the government's pension plan to do, to take over a privately owned business. Of course, that only lasted for a few years, and eventually Lowe's did end up taking over the business, but it did make a lot of promises to the government of Quebec, saying that they would look after the employees that were mostly in the Montreal area. You can also hear, and not one of my usual sources for finance courses, but in Rolling Stone we have an article that talks about looting public pension funds and how this is happening, and the consequences. The implication is that this is a rip-off of the working class by the greedy Wall Street bankers. Well, this is something that happens in a defined benefit pension plan, because companies may decide that the plans are overfunded. There's more than enough money in the plan in order to pay out the existing workforce, the people who've already retired, and so they'll try to withdraw some of the money and use it for other purposes. It's done in a number of different ways. Sometimes we'll hear terms from employers saying that spiraling costs force us to freeze your pension. In the 1990s, large firms in the United States had a cumulative pension surplus of about $250 billion. Employers were looking at restructuring of their organizations, including downsizing of labor forces and outsourcing or offshoring some of those jobs. Partly to fund that, they used the money that was in the pension plans to buy employees out of their pension plans, and so they actually didn't have to pay a penny of the company's money. They just used the money that was already in the fund. Very bad optics. In the long term, it served a practical purpose. It was also something that was very possible because we were in a very good economy. things were going very well, the funds were performing well and generating more surplus. And that's something that wouldn't happen today, not in the same way, because the interest rates and the rate of returns have tended to be lower. By 2008, when we had the financial crisis, all of the surplus had been removed from the pensions and there was no surplus, and that created a crisis with, in some cases, the U.S. government coming in to refinance some of those pension plans, including for General Motors as part of its bailout. They may also say, we're improving your pension plan. And I would be very worried if my employer says, we're improving your pension plan, because clearly that's something that's meant to suit the plan sponsor, the fund sponsor, and not the eventual recipients of those pensions. They may also say that providing a lump sum payment would be better way to compensate workers who are retiring and allow them to create an annuity rather than to continue a defined benefit program. Now, people are living longer, and we have greater expectations of a lifestyle in retirement. And so companies have said we can't afford to fund people for 40 years or 30 years in retirement after they've only worked for us for 25. And so they've tried to get out of that by creating things like single payment annuity programs and having that done privately and outside of the fund scope. So buying people out of their pensions. This happened when the Canadian Army downsized a few years ago. They decided that they wanted to reduce the future pension liability, and they did by providing single payments to soldiers, especially those who are returning from deployments overseas and quite young, but had long pension obligations. We think about how to manage our defined pension plan. Some of the risks and return constraints, well, the risk objectives we've already mentioned earlier. Is the plan fully funded? Is it 105, 110% funded, 70 or 80% funded? If the plan is overfunded, if it's over 100% funded, then clearly there's room to take larger risks, because a small loss of the capital will leave the fund with existing money in the fund in order to continue to operate. The sponsor's financial status may be important, and we saw recently when companies like Sears went broke, the people who were already retired looked at having to take a cut in their pensions after they'd retired, and people who had yet to retire could only look forward to perhaps receiving 50, 60, 70% of their future pensions because the sponsor was not in good shape. So again, some very large companies have downsized over the years, and they've got more people retired than those people working, and their ability to continue to contribute to pay for those pension benefits is also something that's going to be at risk. Companies with a lot of outgoing expenses have got to be more than 100% funded in order to be viable. Common risk exposures. Do you want to invest in things that are similar to the company's line of business? If you are a retail employer and you want to invest in retail businesses, then you're doubling down on risk in that one sector, and that can't be a good thing. There may be special features in the plan, like an opportunity for employees to borrow money from the fund and to use that to perhaps pay off their mortgages. There may be early retirement special provisions that allow survivors to have benefits long after the employee retires. Medical and health benefits might also be part of those plans. And if that's the case, the cash flows are going to be larger, and perhaps they're going to happen at one point in time. We also are worried about the demographics of our workforce. If we have a lot of workers who are in their 50s and 60s and are planning to retire all at once, that's going to create a lot of liability in the short term. We're going to need a lot of cash to be able to pay out those pensions in the next few years. And we're going to have some very long-term obligations. What if our employees retire in their early 50s, as, for example, the military and the police forces often do, or firefighters? That's also going to have important consequences for our defined benefit plans. Those are some of the risk factors. The return factors, well, clearly our return objective is to make sure that we have a sufficient return to fund all of our expected pension liabilities after inflation. Some of the other constraints, well, liquidity, difference between the inflows and the outflows on an annual basis. The time horizon, well, typically it's going to be long, and it's essentially going to go to infinity as long as we continue to operate as a going concern. Taxes, well, the earnings that are produced by the fund itself before they're dispersed are completely tax-free. The tax liability flows through to the beneficiaries. So we don't really have to worry so much about tax. We're indifferent whether we're going to earn the money through capital gains or through interest and dividend payments. There may be significant legal and regulatory overheads or burdens because governments want to make sure that pension plans don't fail. I mentioned earlier, General Motors had significantly underfunded their pension plan. Eventually, the government had to bail them out. If a company like Sears goes broke, who's going to provide for those workers after the company's gone? Companies are regulated by provincial regulators, in our case, to ensure that there is going to be sufficient liquidity in the pension plan for it to be viable. There may also be some unique circumstances tied to perhaps the company's own financial condition and its short-term, medium, long-term plans, and also restrictions on investing in certain kinds of businesses. Some of the things that we're going to have to consider for our risk tolerance, well, the plan surplus we've mentioned before, the sponsor financial status, the common risk exposures, we just talked a little bit about that, special features, and the workforce characteristics. That's specifically what we're going to worry about with those risks, things that we've already mentioned. The kind of things that we're going to invest in, well, it's the kind of things that are going to provide the kind of cash flow that we're going to need to fund our future liabilities. Here we start to introduce a new term called Asset Liability Management, or ALM. It's exactly what it sounds like. Our main liability or obligation is the pension funding requirement. The assets then have to be the kind of assets that are going to give us the right kind of return and also the right time horizon. So if we have a lot of 5-year liabilities, things that we're going to have to pay out in the next 5 years, we want to have assets that are going to mature in that 5-year period. We'll talk a little bit more about that in just a minute. We may also have a risk objective that's going to be tied to the amount of surplus. So we have 110% funding for the plan. 10% will be the part that we can take greater risks with. 100% part, well, that's the part that's going to be required to fund our liabilities, and we'll be more conservative with that. It may also be phrased in terms of shortfall. In other words, we have an expected shortfall of $5 million for the next 5 years because of low investment returns. That shortfall is the major concern of the plan. I mentioned earlier the risk factors are risk tolerance and plan surplus. Are we in surplus or deficit? Higher surplus means we can have greater risk tolerance. Financial stability, the debt to assets of the company, the employer, as well as the fund, and our current and expected profitability. Lower debt ratios, higher profitability mean we have greater risk tolerance. Again, a position that the employees and their unions are going to be concerned about when a company itself becomes over-leveraged. Not only is the company putting its shareholders at risk, but it's also putting the pensioners at risk and the employees. Common risk exposure. If we're in the oil business, we know the oil business, we see a lot of interesting opportunities to invest in other oil companies. That would be compounding our risk exposure in that one sector, and it's probably something that we shouldn't do. So we want to maintain a low correlation of our pension fund liabilities to the firm liabilities. I mentioned earlier some of those plan features: early retirement, plan borrowing, lump sum distributions, perhaps if there's a single payout at the beginning of a pension plan. The more optionality, the greater the risk that we're taking. They say the lower the duration of the liabilities, so the assets are going to be much more of a factor in that case, or an asset liability mismatch, a more important factor. We're also worried about the age of our workforce. The younger the workforce, the less we're concerned about our pension plan. We have a lot of time before that pension liability is going to mature. If we have our average age of our workers is quite high, or our workers are likely to retire at a younger age, then we have greater risk concerns. Asset liability, ALM, is a term we're going to be talking about for the rest of the semester. It's something that we talk about all the time in financial institutions, and it's really about matching liabilities with assets. If you have a lot of long-term liabilities, your assets can be long-term assets, and we get a higher rate of return typically on longer-term investments. So a long-term ALM match is a good thing for the company. If we have a lot of immediate liquidity requirements, if we have a 60-year-old workforce and they can claim 3 years worth of their pension in the first year that they retire because of that optionality, we have a serious problem of liquidity. Our assets have to be very short, and short-term assets typically pay lower rates of return. There are a number of terms that you may hear, like accumulated benefit obligation, or ABO, and that's the present value of pension benefits, assuming that the plan stopped today. We just stopped our operation, and from that point on we just paid out. Projected benefit obligation is like the accumulated benefit obligation, but in this we project things like the future increases in employment, the future increases in salaries, and essentially treat this obligation as a going concern rather than as a static model that the ABO uses. And total future liability throws everything into the mix and says, what are all of the potential liabilities and all the potential benefits that are going to affect us? And this is going to be the most conservative measure that we use. We also will probably want to know what the difference between retired and active employees is. For this, we're also going to consult things like those famous mortality tables that suggest that if your workers are smokers and they drink and they enjoy adventure sports, they have a very short expected lifespan, and we don't have to provide a lot of money for their pensions. On the other hand, if all of our employees are fitness freaks and they don't smoke, they don't drink, and they hate cholesterol, well, we better produce a lot of provisions for those people. Return requirements, quite simply, we need to achieve returns that are going to adequately fund all of our pension liabilities after paying for inflation. So we take a look at the current status of funding in the plan, and also the pension contributions that we're going to make relative to the payments that we're going to have in the next few years. For this, we have to think about the appropriate rate of return for our investments. Or do we expect to get 3%, 4%, 5% rate of return? Remember, we're talking about conservative investments. And so being able to earn a rate of return greater than inflation is not necessarily something we can take for granted. Our return is going to increase with the increased asset duration. So if our assets are longer term investments, we expect to get higher rates of return. And we may have different risk and return strategies for the currently active employees and the employees that are already retired. Most of these features are going to be managed by external bodies. In fact, there are a lot of jobs in pension management because we do this internally. We have fund managers who look after the funds that we provide. We have advisors who evaluate our fund managers. And then we probably also have another firm that looks at our overall strategy, because we have several different fund managers and several different advisors. So it may be that one person who's retired might be funding a quarter of a person in the financial industry who's looking after their pension. Some of the liquidity requirements, well, liquidity is going to depend on the proportions of our retired employees to the ones that are still working. One company that I worked for, we had something like 3,000 employees who were retired and 2,000 people who were still working. And there was a great incentive to retire early. So we had far more people that were earning a salary from the company's ongoing operations than those people you actually saw around the plant. The smaller the contribution, the corporate contribution, the greater the liquidity requirement. If the company typically provides half and the employees provide half, then there's going to be a greater requirement for liquidity. Early retirement, lump sum payments, policy loans of sorts, those things could create greater liquidity requirements. Our time horizon tends to be a very long-term single period, but we also have to adjust that for differences and changes in the age of the workforce, and whether or not perhaps we have more people that are retired than we have people that are actively employed. Tax concerns, as I mentioned earlier, most financial organizations don't actually have to worry about paying tax. The tax liability flows through to the beneficiary. So eventually when you collect your pension, you're going to pay tax on it. And governments have decided that it wouldn't be fair to tax you twice. So the income that's received, the capital gains, they're all priced at the same rate because we don't have to worry about income tax. There are a lot of regulatory bodies in the U.S., as our textbook shows. There's something called ERISA, which essentially regulates on a nationwide basis all pension plans. Basically says you can only invest a certain percentage in these kind of assets. Things that are very risky, like private equity, perhaps 0.5%, but no more than that of your total funds under management. And the level at which the funds are topped up is also going to be regulated, but the regulations change over time, and ERISA is often something that we see tacked on as a rider in budget bills in the United States because companies benefit when the requirements are reduced. In Canada, our regulation is done at the provincial level, as I mentioned earlier, and they have bodies on a provincial level that act like ERISA, but their rules are going to be different from one province to another. Of course, this being Canada, we do tend to copy what's done in Ontario, and that most of the provinces have very similar type of regulation, but there is scope for that difference. And in BC, this is managed by the Financial Institution Commission and the Pension Benefits Standard Act. And so this is something that if you are going to work in this business, you need to know about. Now, most of that was entirely about defined benefit plans. Defined contribution plans are much simpler to operate because essentially what I get out of my defined contribution pension plan depends on how much I put in, how much my employer put in, and what I invested it in. If I took a lot of risks over a long period of time, then my eventual benefit could be much greater than a defined benefit plan. And in a lot of cases, this is the way that pensions are going. People are more and more responsible for the performance of their individual pensions than they'd ever been in the past. So the only issues for sponsors are diversification. There may be a number of different investment opportunities that are offered to employees, 5 or 6 mutual funds perhaps operated by 1, maybe 2 organizations. And there may also be limits to investment in things like company stock or even in your own mortgage. The sponsors' investment policy statements provide a way of demonstrating to external bodies, to the unions, that the company has met its legal fiduciary responsibilities and provided the type of plan options that they said they would. And every individual is going to be responsible for their own investments. There is a hybrid of defined benefit and defined contribution. Essentially, hybrids try to provide the best combination of both: portability of assets, low administrative costs, easy to communicate to employees, and they provide some of the defined benefit plan guarantees, for example, minimum level of returns, special targets for or rewards for length of service, and the ability to to link your retirement income to some percentage of salary. As in the defined benefit plan, the employer bears more investment risk, but the employee receives a much simpler and easier to understand statement of returns. A different type of hybrid plan is an employee share ownership program. And in ESOPs, or employee share ownership plans, essentially these are ways that we encourage employees to invest, usually in our own company. Of course, there's a downside with that, because if you put the money into your company and the company goes broke, you could face a large loss. And your source of income comes from that same source. In fact, the worst case that I can imagine is some of my ex-students were working for Enron in London. And we were talking about this just before the company folded. And they were kind of laughing about it, but they said, yeah, we love Enron. It's our employer. We get great bonuses, great salaries. And the but was, well, these people had expectations of a great retirement with a really good pension provided by Enron. They had bought a lot of stock in the company at a very good price, a discount price for the employees. Some of them had borrowed money against their houses in order to invest in Enron. When the company went broke, they lost their pension, they lost their job, they lost their ESOP because the company shares had gone down to nothing, and many of them had also borrowed money against their houses to buy the full allocation of shares, and so they pretty much lost everything all at once. So that lack of diversification becomes an issue. That's all I'm going to say today about pensions. It's certainly a good introduction. Check out Chapter 3 in the textbook for some more details, and we'll be discussing this a bit in class. In the next video, we'll take a look at institutional portfolios and the way they work for foundations and financial institutions.